In the early 2000s, the American economy seemed stronger than ever. The real estate market was booming, housing prices were steadily rising, and everyone believed that property values would continue to increase indefinitely. Banks were offering loans to more and more people without checking whether they could actually repay them. A new financial product, subprime mortgage loans, became the driving force behind this growth. These loans were given to individuals with low incomes and poor credit histories, under the assumption that housing prices would keep rising forever. However, banks did not keep these loans. They resold them to investors, packaging them into complex financial products known as CDOs, collateralized debt obligations. Wall Street encouraged this practice, as the creation and sale of such products generated massive profits. Investors worldwide bought these CDOs, relying on the high ratings given by agencies like Moody's and S&P, which classified them as AAA investments. However, no one truly understood what they contained. The housing market kept inflating. People were buying homes with zero down payments, banks were granting loans without guarantees, and real estate agents were pressuring clients to purchase, promising easy wealth. The system seemed unstoppable, but in reality, it was built on a foundation of debt and greed. Banks and investment firms played a crucial role in both creating and worsening the financial crisis. Major banks like Goldman Sachs, Lehman Brothers, and Merrill Lynch were not just passive observers of the housing bubble. They actively fueled it by designing and promoting toxic financial products. The system was built on subprime mortgage loans, which were issued to borrowers with low incomes and unstable financial backgrounds. Banks were not concerned about repayment because they quickly sold these loans to investors, turning them into CDOs, collateralized debt obligations. These products were then marketed to institutional investors, pension funds, and insurance companies as supposedly safe investments. The greed of banks knew no bounds. To generate even greater profits, they created complex variations of CDOs, such as synthetic CDOs, which were essentially bets on already risky loans. These practices heightened the system's instability, inflating a massive financial bubble. At the same time, banks benefited from misleading ratings by agencies like Moody's and S&P, which assigned high grades to products filled with toxic debt. As a result, Wall Street continued to profit at the expense of the real economy, building a market based on illusion rather than actual value. When reality finally set in, the system began to unravel. While most economists, banks, and investors ignored the warning signs, a small group of individuals realized that the financial bubble was bound to collapse. The key issue lay in subprime mortgage loans, which were issued without guarantees and bundled into complex financial products. Michael Burry, a hedge fund manager, analyzed the data and discovered that most loans were doomed to default. He saw that borrowers were unable to repay their loans and that the housing market would soon crash. Steve Eisman, a Wall Street investor, also recognized that banks were creating massive risks without fully understanding them. Additionally, some analysts noticed that CDOs were mistakenly rated as safe investments, when in reality they were filled with toxic debt. The market was built on false assumptions and fabricated data. Those who understood what was happening bid against the market, wagering that the bubble would burst. And they were right. When interest rates rose and the first wave of loan defaults began, the system started to unravel. In 2007, the housing bubble started to burst. Home prices, which had been rising for years, stopped increasing and began to decline in many areas. Borrowers who had taken out mortgages with low interest rates faced sudden payment increases, leading many to default. As the first wave of mortgage defaults began, banks holding CDOs faced massive losses. Investors who had bought these products believing they were safe investments started to panic. The entire financial system had been built on the assumption that housing prices would never fall. When that assumption collapsed, the consequences were catastrophic. In September 2008, Lehman Brothers went bankrupt, marking the largest banking failure in U.S. history. Markets plunged, and the global financial system entered a crisis. Governments and central banks were forced to intervene to prevent a total economic meltdown. In 2008, the financial crisis reached its peak. The largest banks on Wall Street faced unprecedented losses as subprime loans collapsed and CDOs lost their value. Lehman Brothers, unable to find a buyer or receive government support, declared bankruptcy in September, triggering panic in the markets. After Lehman's collapse, trust in the banking system vanished. Banks stopped lending to each other, fearing further bankruptcies. Stock markets plummeted, with the Dow Jones experiencing historic drops. AIG, one of the world's largest insurance companies, stood on the brink of collapse, forcing the U.S. government to intervene with billions of dollars in bailouts. The crisis turned into a global recession. Companies laid off workers en masse, millions lost their homes, and unemployment skyrocketed. Governments responded with massive rescue packages to prevent the total collapse of the financial system. The 2008 crisis exposed how greed and mismanagement in the financial sector could devastate the global economy. The 2008 financial crisis left deep scars on the global economy. Millions of people lost their jobs and homes, businesses shut down, and trust in the banking system was severely shaken. Governments were forced to inject massive amounts of money into bailout programs to prevent a total collapse. However, the burden of these bailouts fell on taxpayers, leading to social outrage and widespread skepticism about the financial system. Central banks, such as the Federal Reserve and the European Central Bank, introduced quantitative easing programs to stabilize markets. At the same time, governments worldwide implemented stricter financial regulations, such as the Dodd-Frank Act in the US, to prevent another crisis. However, many believe that Wall Street never truly learned its lesson. The key takeaway from the crisis is that greed and reckless risk-taking can bring entire economies to their knees. People realized the importance of financial literacy and careful money management, both personally and corporately. But the question remains, have we truly learned from the mistakes of the past, or are we laying the groundwork for the next major crisis? The 2008 crisis was one of the greatest financial disasters in modern history, but it taught us invaluable lessons. The economy may be unpredictable, but knowledge is power. If you want to continue exploring crucial financial events and books that challenge our way of thinking, make sure to like this video and subscribe to the channel. Drop a comment below. Do you think the financial system is safer today, or are we simply setting the stage for the next crisis? Let's start a meaningful discussion. Until the next video, stay informed, stay strong, and keep thinking critically.